Hi everyone. I hope there's a few of you here, but it's lovely to be speaking to you all. We'll start off by introducing ourselves and then we'll jump into the webinar. So to start off with, my name is Sophie. I'm a senior lawyer here at LegalVision in our corporate transactions team. So a lot of the work that we do is with startups, helping them as they're first establishing and setting up their business structures and their employee equity plans, and then also helping them as they grow and they raise capital as well. And in that context, there's often a lot more maths involved than I would necessarily expect as a lawyer. So that's when I get my colleague Chris involved as well, so he can introduce himself.
Yeah, hey guys, Chris Bambury here, the head of finance at LegalVision. I joined LegalVision 2 years ago to get into the startup scene, and obviously a lot of the people in this webinar today, are in that scene. I absolutely love it. There's new things every day, but yeah, it's a massive learning curve, and hopefully we can provide some more insight to you guys today. So yeah, we'll get started. I guess, so Sophie, what is a cap table and why is it useful?
Yeah, so the first topic that we'll be talking about is cap tables. And so firstly, to explain what a cap table is and why it's useful. So a cap table or a capitalization table refers to a spreadsheet that sets out the company's share capital as well as other forms of equity such as options. It's really useful because it consolidates and presents who owns shares and also who has rights to acquire shares in the company, all in the one place. So it allows you to visually see what the company's ownership looks like and how this might change in the future. It's also a really useful way as well for you to model how certain transactions will affect the company's ownership over time. So for example, how a capital raise or the introduction of an ESOP will affect the share structure going forward.
Yeah, that's interesting. I guess you mentioned there an equity round. Can you elaborate a bit more on that and how that affects, the people in this webinar today?
Yeah, so one of the main uses for a cap table, and certainly as a startup founder, one of the ways that you'll be seeking to use a cap table is for an equity round, and modelling and working out the key terms for that. So as part of that, the first step when you are using a cap table for an equity round is to input the company's current share capital. So you would include the company's current fully diluted share capital. So the shares that are on issue, as well as anything else, any other equity interests that are on issue as well. So any options that you've already granted or any convertible securities as well. As well as the approved ESOP pool, if you've actually already approved an ESOP pool by that point. The next step would be to use the cap table to actually calculate the economic terms of the raise. So you'll input the key details that you've agreed with your investors, such as the pre-money valuation. If there is going to be an increase to the ESOP pool, you'd include those terms in there as well, because that might affect the pre-money and also the share price that ends up being calculated. And then you can use the cap table once all those details are in there to calculate the share price and also the number of new shares that will be issued to new investors. Yeah, and that's super useful, obviously, for your own benefit, but certainly when you're doing a raise, your investors will want to see the cap table because they'll want to verify how you've calculated the share price and how you've calculated the number of shares that they will be receiving, and they'll likely do their own independent checks as well, just to make sure that it all works out.
Yeah, you mentioned so you mentioned they're pre-money, and I guess we come across this a lot, pre-money and post-money. Can you explain what the difference is for that, and how that can affect the cap table and an equity round?
Yeah, absolutely. So these are common terms that you'll hear founders and investors talk a lot about in this context. And it's really useful and really important for the cap table because it affects the share price and the number of shares that you'll be giving away. So the pre-money refers to the company's current valuation before the investment monies are received. And that's going to be the valuation that you're using to work out things like the current share price, which is the amount that the investors are going to be paying for their shares. And then the post-money valuation refers to the company's valuation after the investment monies are received. So the simple maths on that is that the post-money valuation is what you've agreed the pre-money is plus the investors' investment monies.
Yeah, that makes sense. And I guess as a founder, you want to be, really, confident in those values that what you're coming to as well. So I guess as part of that, you mentioned sorry, you mentioned the diluted and undiluted holdings in the cap table. Can you explain a little bit more of that and how it actually works?
Yeah, so these are also common terms that you'll come across a lot when you're talking about cap tables, is undiluted and fully diluted holdings. So the benefit of the cap table is that it will show your fully diluted and your undiluted holdings. So undiluted refers to just the issued shares. So it doesn't include any other interests that might end up being shares in the future, like options and other types of convertible securities. It only refers to the actual issued shares, whereas fully diluted includes all of those interests. So it includes the shares and all other interests which are exercisable or convertible into shares, such as options, safes, convertible notes, warrants. And it's really useful for a cap table to show both of those things because your investors will want to see the fully diluted interest, and they'll be investing on that basis because they'll want to understand not just what their actual shareholding percentage is on an undiluted basis, but they'll also want to know how their shareholding might change and be diluted over time.
Yeah, that's very good input. And I guess it's so important for founders to know their position, just so you're across how much you're going to get diluted in an equity round. Isn't that right?
Oh yeah, absolutely. Yeah, yes, certainly from the investor's perspective, but from your perspective as well, you'll want to know how your interests are changing over time as a result of all of those transactions.
Great, no, thanks for that. So moving on, there's different types of shares that can be issued. Can you sort of elaborate on those different types?
Yeah, certainly. So one of the inputs that you can use the cap table for in reflecting is actually the different classes of shares that are on issue and also the different classes of shares that you might be issuing to the incoming investors. And this is really useful to see in the cap table for a number of reasons. So one is that it's useful to work out the potential financial returns. So it's likely going forward, if you do raise multiple rounds of financing, that you'll not just have ordinary shares, but you might have different classes of preference shares as well that will have different interests in terms of a financial return if there is a liquidity event or a winding up. So it's useful to see that. It's also really useful as well to identify who holds certain control and decision-making rights. So for example, if you do a round of capital raising, it might be quite common for the group of investors in that round to hold certain decision-making and control rights. So for example, holders of at least 50% of the seed preference shares have to approve these certain matters. And so by setting out and reflecting the different classes of shares in your cap table, you can visually see who actually controls those decision-making rights and who, at a very minimum has to agree those things.
Yeah, that makes sense. And I guess, beyond, the simple equity raises that we do, there's a number of, financial instruments that we've seen. What are those common instruments, and, how do you work with those, I guess?
Yeah. So apart from using a cap table for an equity financing, you can also use a cap table when you're thinking about convertible instruments. And this is definitely something that when Chris and I were working on producing our pro forma cap table, it was front of mind for us because it is something that does come up a lot. Because as startup founders, you might do your pre-seed financing or bridging rounds using convertible instruments such as safes and convertible notes, which we do come across a fair bit. And it's really useful to use the cap table for that purpose, because when you do come to an equity financing, you'll need to understand what the consequences are of converting those convertible instruments, because it is usually the equity financing that triggers that conversion. And so you'll want to use the cap table to demonstrate the impact of both the equity round as well as the conversions of those convertible instruments. And that's definitely something that your incoming equity investors will want to see in the cap table as well.
Yeah, and I guess we've obviously over the years we've done a lot of convertible notes, but there's been a lot of variations recently, which is really important that you understand what the terminology in those convertible notes are, just to make sure that what you're putting into the cap table is correct. Yeah, as Sophie just mentioned before, we've recently launched our free cap table. And what we're going to do right now is just go through a quick demonstration on how it works. We're going to do a simple equity raise. And yeah, I'll
Sure,
pass
just
you
give
over to
me
you,
a
Sophie.
second. Let me set up. Cool, I'm all good to go. Tony, if you want to share my screen. Great. All right, can you see that, Chris? Is that all good?
Yes, I can. You're good to go.
Perfect. All right, so as Chris said, very excited because we have a new cap table that we've launched fairly recently that we've been working on for a while. And so we wanted to show it and also use this as an opportunity to demonstrate some of the things that we've just been discussing. So the first thing that I will say is, as I mentioned, this cap table actually does have the ability to work out and do calculations for convertible instruments, but just in the interest of time, I won't go into detail there, but that's what that's referring to. And there are other sections of the cap table where you can, for example, like here, where you can input those details if they are relevant. But yeah, we'll just stick to demonstrating inequity financing in this instance. So yeah, the first step, as I mentioned earlier, is to input the current share capital. So here in the cap table, you'll see that Chris and I own 100% of the company at the moment. I own 400,000 shares and Chris owns 400,000 shares. And so the current share capital is just that 800,000 shares. And there's also the ability in the cap table to include any other securities which are on issue at the moment. But because this is a new company, Chris and I haven't introduced an ESOP yet, so there's nothing in place, it's just our shares. And then the next step that you would do is to input the terms of the deal. So for example, in here, you can include the pre-money valuation that's been agreed with the investors. You can input if there's going to be an ESOP that's implemented or increased that you've agreed with your investors. So in this case, we've agreed with our investors that we'll introduce a 10% ESOP. And then you'll see from there on, these actually work out the calculations for the deal based on those inputs. So you'll see that we've started out with a pre-money valuation of $5 million. The new investors are investing $1 million, and so we get to a post-money valuation of $6 million. One of the tricky things that founders have to grapple with when they're using their cap table to work out the share price is thinking about the impact of the ESOP. So one of the things that you'll find investors often ask for is that they don't want to get diluted by the ESOP and say they want you to essentially treat the ESOP as coming out of the pre-money. And so you'll see here that we've got that 10% ESOP, which is worth $600,000, being 10% of the 6 million pre-money. And so effectively our 5 million pre-money has been reduced by the value of that 10% ESOP. And so you actually get a true pre-money of 4,400,000. And then you use that to divide by the 800,000 shares on issue, which leaves us with the share price. And then once you've got the share price, you can work out the number of shares that the new investors are getting, which is here. And then in this section as well, you can deal with, you can see the impact of that investment. So, I'm just moving that. So in this section here, you get the post-investment numbers. So you can see, as we were discussing earlier, the undiluted and also the fully diluted holdings. And you can see in the fully diluted section, they're of course slightly less as a result of the impact of the ESOP. So yeah, that's our little demo, and we can move back to the slides now.
Cool. Thanks for that, Sophie. And obviously, guys, that cap table is available to everyone on this webinar today. So you will get a link to that. And if you have any questions, just please shout out after the session and we can help you with that cap table as well. I guess it's one thing that we need to note with that. There is a number of variables, in that cap table. So it is a complex tool. Because we've tried to, factor in all the different variations that we can get. But yeah, as I said, if you've got any questions, reach out and we can help you out with that. So we're moving on to the second part of the webinar is basically ESOPs. So I guess, Sophie, can you explain what an ESOP is?
Yes. So an ESOP refers to an employee share option plan. And I will flag up front that even though it is referred to as an employee plan for legal and tax purposes, ESOPs can actually be used for a broader variety of people. So you can use it for contractors, directors, advisors, but just for present purposes, I will refer to it as an ESOP, and I'll refer to employees as well. So under an ESOP, a company grants options to employees which may be exercised into shares upon the employees meeting certain conditions, which can be time-based or performance-based conditions. And ESOPs are used by companies to incentivize and reward employees and to align their interests with the companies. So if the company succeeds, then the value of the employee's equity increases, and the more likely it will be that they'll receive a financial return as a result. It can also be a really useful way as well for startups to boost an overall remuneration package where they can't match the market rate for someone's salary. I will flag though, even though ESOPs are super useful and they're a really common tool for startups to use, of course you should be very considerate and really careful when you are implementing your ESOP and making equity grants, because ultimately if the company does do well, then the equity is going to be more expensive than cash in the long run. And you also need to be aware that under your ESOP pool, there will be a cap on how much you can give away, and that's something that you'll agree with the other shareholders and any investors that you have. And so you still need to be careful about, thinking about those parameters as you're making those grants.
Yeah, that makes sense. And I guess, what are the standard terms that we see in ESOPs?
Yeah, so in terms of the standard terms that we see, two of the critical terms that we often discuss with our clients quite a bit. The first one I'll discuss relates to vesting. And so this is really important because ultimately, if you're using this as an incentive for employees, you want to make sure that they're hitting the milestones that you require before they actually get their shares. And so for vesting, I will say that time-based vesting is more common than performance-based vesting. And the reason for that is because it's an objective standard and it can be made consistently amongst employees really easily. For example, probably the most market standard time-based vesting schedule would be 4-year, monthly or quarterly vesting, which includes a 1-year cliff. The other key term that we discuss quite a bit with our clients as well is when the employees are actually able to exercise their options into shares. And so in Australia, the two most common times when employees would be able to exercise their options is either when their options have vested, or sometimes companies prefer to restrict the exercise until an exit event. And so if you do allow your employees to exercise once those options have vested, that can be really beneficial from the employee's perspective because it can be quite incentivizing and they feel like, they're getting that tangible interest in the company. But certainly as you grow and to future-proof the company, think about what the impact of having lots of employee shareholders will be. And to that point, when our clients want to have that kind of arrangement, we do make sure that their terms allow things like the company being able to set up, a trust arrangement so that they can streamline their share register in the future and avoid lots of minority employee shareholders.
Yeah, that's really interesting. I just want to go back to something you mentioned at the start of that. You mentioned a 1-year cliff. Can you elaborate on that and what it actually means?
Yeah, so when it comes to vesting terms, you'll hear this quite a bit when people talk about cliffs. And so cliffs refer to the minimum amount of time that someone has to be working before they're able to vest any of their options. So if it's a 1-year cliff, so going back to our example earlier about 4-year vesting, which includes a 1-year cliff, that would mean that they would, the employee would have to work for at least a year before they're able to vest 25% of their options. And then for the 3 years following that, the remaining 75% might vest on a more consistent basis. So say on a monthly or quarterly basis after that.
Yeah, and I guess the benefit of that is, for the business, if someone was to leave within the first year, all those options would essentially lapse and they will come back into the option pool for the company.
Exactly right. Yeah. So you avoid a situation where you offer someone options and they might leave really soon after, and then you're stuck at least with them being able to retain the amount of options that they would have vested in that time. Yeah.
Great. And I guess what are the other things that we need to consider when granting options?
So this is something that does come up quite a bit for the founders that we speak to, and of course it's something that is a really important consideration, which is how much equity do I actually grant to people, and this is tricky because there is definitely no rule of thumb or no perfect system that fits every single company. How much to issue really does depend on the stage of company and also how much ESOP pool you have available as well. So although there is no particular rule of thumb to issue a particular person, there are certainly market standard ideas around how much ESOP pool you should have. So for example, probably the most standard threshold for an ESOP pool for early stage companies is around 10%. And so if you use that as the ceiling, then you can work backwards to think about, what are the key hires that you need in order to get to the next milestone or to get to the next capital raise where you might top up your ESOP pool, and then you can work backwards from that cap. So for example, if you do have someone that's asking for say 5%, it's important to not just think about that in terms of 5% of the overall company, but you also need to think about that as 50% of your ESOP pool. Will you have enough remaining for the other key hires that you need to make? And it's also really useful as well, once you've made those key hires, to keep some remaining in the pool if you can, because you might want to top up offers made to certain key team members. And something to be conscious of as well is that over time, your ESOP pool might increase, and also your ESOP policy and strategy might change as well as the company matures. So for example, some of our more mature startups that we work with that have higher company valuations, their ESOP strategies are of course different than really early stage companies, because they're able to offer small lots of options which are still really valuable, and so they might include say 50k of ESOP in addition to salary to most of their employees.
Yeah, great. No, that makes sense. And I guess the next part we're going to talk about is, how we value the options when issuing them to employees. So what I'm going to refer to here is basically the early stage startups. So most of these can rely on the net tangible assets test, which is a safe harbor valuation methodology, which is available for all these startups. There's a couple of key criteria that we need to look at to make sure that we qualify for that. And that key criteria is we've not had a capital raise of more than $10 million during the 12 months immediately before the valuation. And at that time of valuation, the company has been incorporated for no more than 7 years. So any company that's beyond that 7-year threshold, we cannot use the safe harbor methodology. And also, at that point in time, the business needs to be a small business entity as defined by the Income Tax Act. So what we've also done as part of this webinar is we provided a link to the ATO website, which clearly shows out what needs to be done when valuing using those tests. So it's a really helpful tool for you guys to review. The next part is for businesses that cannot rely on that net assets test. So there's an alternative comprehensive method. The valuation of ordinary shares needs to be done by either the CFO of the company or a person having the knowledge, experience, and training to perform such valuations. So typically these will be your accountants or corporate advisors that can help you with this. What needs to be taken into account with these valuations is a number of things. It's not just how much your revenue is or how many or what your assets are. It needs to be a multiple of variables. These variables can include the value of tangible and intangible assets of the company, the present value of anticipated future cash flows, the market value of similar businesses, which includes the use of earnings multiples. And basically we also provide, an allowance for any, control premiums. So uplifts and discounts, lack of marketability, and any key person risks. So the model that we typically use, or what valuers use for this, is a discounted cash flow model. And basically this model can function with all those different metrics. It is complex and it is very subjective, but it is a tool that is approved, and it's really helpful when valuing, I guess, options and shares. And yeah, we've just provided the link there, and that will be sent around later on as well. So guys, we've just got to the end of the actual content, and we've just seen a number of questions come through. So we'll try and answer as many as possible. So just bear with us for a second as we go through those.
Sure. While we're doing that, Chris, I'm happy to jump in because we did get some questions that were emailed to us in advance.
Great.
So I think we'll do two of them here. So the first one I can answer. So someone had sent in a question asking that if they've agreed with an employee that they're going to get a certain percentage of the company under an ESOP, is the company required to maintain that percentage when issuing new shares? And this, I think, is a really interesting and useful question to have, because one of the misconceptions that people often have when they're talking about ESOPs, or when they're talking about just equity in general, is that we often speak about it in terms of percentage holdings, which makes sense for commercial purposes. But when we actually go to issue shares, or when we actually go to grant options, we actually need to be offering a particular number of options and a particular number of shares. And so that does mean that even if you've represented to somebody that they might get a certain percentage of the company, by the time that you actually go to grant their options, you will need to determine the exact number of options and therefore the exact number of shares that they will end up being entitled to. And so that does mean that if after you've granted those options, the share capital changes, so for example, you raise a round of capital, it does mean that that person's percentage holding will be diluted the same way as anybody's shareholding will get diluted. And that is just the nature of, holding equity in the company, whether it's via options or via shares. So that is something to be conscious of, is over time that number will get diluted, even if, that might not necessarily be the employee's intention to begin with, but they do have to be comfortable with, the fact that that is the reality of what's going to happen. And so the next question, which I'll hand over to Chris for actually, is what are some strategies to address debt equity, which I think when we were talking about this beforehand, we think about this in the context of what happens if someone were to leave. So Chris, I'll hand it over to you.
Yes, obviously debt equity is basically, we're saying that a person has chosen to leave the business but has vested shares within that company. So the best way to mitigate this risk is, when you're setting up your ESOP, is to make sure that you have terms in there that allows the board to buy back, or potentially to buy back someone's options in the event that they leave. And that's really important, just because if when you're issuing options to a lot of people within the business, and a number of them leave, and you don't see them being part of that future of the company, that basically gives you the potential then to be able to buy it back at a fair price to the option holder as well. But then it allows the business to retain those options to be able to issue them to to future employees, or to increase someone else's holding that you see value for in the future. So yeah, that's the best way to do it. And the key part of that is addressing that when you set up your ESOP plan. And that's what Sophie does, on a day-to-day basis. And they're really good at, providing that advice. All right.
Right. So let's work through now some of the lots of questions that have come through. So the first one that just jumped out to me, which I think is a really useful question, because it does actually relate to what we were talking about earlier in the cap table demo that we were doing, is, since the investor is investing on a fully diluted basis, does this mean that they will own a higher percentage of the company initially, and this will go down to the intended percentage as all the options are exercised? So that's really prudent, because that's exactly correct. So this is what the investors are essentially doing when they're saying they want the pre-money to include the ESOP and they don't want to take the dilution for the ESOP. So effectively going through that calculation that we were doing earlier when we were doing the cap table demo, the impact of that is that the share price is actually slightly lower as a result of including that ESOP in the pre-money, which results in the investors getting slightly more shares, which means that once the ESOP is fully granted, it will go down to the intended percentage. So yeah, that's exactly correct. Okay.
Cool. I think I can jump in for one here.
Yeah.
So we've got a question: is pre-valuation needed to be done by a professional services firm, or based on the value that founders see? At the end of the day, it is, but you know, someone is investing in your business on the value that the founder has basically thinks is there. You know, a lot of these early stage startups, you can't value anything. You know, there's no assets. You know, there's sometimes no goodwill. You know, the brand is very small as well. So really, you're investing in an idea, really. So typically, a professional services firm, you know, won't provide a valuation for that. It is the founder. And you know, you need to mutually agree with those investors as well. You can't just say my business is worth $100 million because you know that's just not the case. So it is, you know, what the founder perceives their business to be worth, but also in agreement with those investors. And that's the easy way of doing it. And that can be done, you know, in multiple different ways. It could be on a revenue multiple. It could be on an EBIT multiple. But yeah, that's, and it can be difficult, that's for sure, but that's the typical way that it's done.
Yeah, and so the next question just after that we got as well, which relates to our earlier discussion about having different classes of shares, is someone was asking what is the difference in rights between seed preference shares and ordinary shares? And this is definitely something that if you're raising capital, you need to end up being familiar with, because you will hear investors, especially as you're doing larger rounds of capital, talk about preference shares. And so, yeah, when it comes to ordinary shares refer to rights that just have, you know, all of the standard rights that you would expect to have as a shareholder. So the right to attend shareholder meetings, the right to vote, the right to receive dividends, the right to participate in the proceeds if there's a winding up. Whereas with preference shares, they will have all of those same rights, but they will also have a preferential right to the return of any income or capital. And so when it comes to income, this isn't always the case. Often preference shareholders are happy to participate in dividend distributions, the same as ordinary shares. But where the critical difference often lies, and where you'll end up negotiating this with investors and what they really care about, is being able to have a preferential return in the event of a liquidity event or a winding up. So for example, if the company were not to do well and it would have to wind up, then an investor that had preference shares would be able to exercise their liquidity preference to get their initial investment monies back, in preference to any returns of remaining funds to ordinary shareholders. So it's a way of protecting their interest by knowing that, you know, if it didn't turn out well, then they would at least have to get their money back first.
Yeah, great. We've just got another one come through here. So can you set different vesting conditions for different employees, or do they all have to be common across all ESOPs? The answer is you can do really whatever you want. The standard terms is what Sophie spoke about before, is, you know, 4 years with a 1-year cliff and vesting quarterly. But what you can do is, if you have a project, a 3-year project that you have someone working on, you can change the terms so that you know, the options vest over those 3 years. So at the end of the day, it is up to you guys to choose what that vesting schedule is. And yeah, there's no right or wrong way really of doing it.
Yeah, and so the next question that I'll answer, I can see that we've got a few questions to this effect, is how you work out the number of shares that you start off with before you do things like your ESOP and before you raise capital. So this is actually a really useful question to have, because it is something that will end up changing. So when you first incorporate your company, it's very likely that you'll end up just setting up with a nominal number of shares. So, you know, 10 shares or 100 shares to start off with. And the reason for that is because you still need to pay for those shares. And so it can be, yeah, quite problematic and inconvenient if you try and incorporate a company with, you know, 1 million shares or 10 million shares to start off with, because you might end up actually having to pay quite a lot of money for them. So for that reason, it's very standard and typical that you would just incorporate your company with, you know, 100 shares or 10,000 shares to start off with. And then before you introduce your ESOP and before you raise capital, it's very likely that what you'll do is a share split, which effectively subdivides the number of shares that are already on issue to get to a greater number of shares. And because it's just subdividing those existing shares, you don't need to pay any more money for new shares. It's just using the existing share capital. And so, yeah, before we do, for example, the first round of financing for a client, it's nearly always the case that we'll end up needing to do a share split for them to get them from, say, 100 shares to 1 million shares, so that they're actually able to, issue shares in the correct percentages that they'd like.
Yeah, great. We've just got another one here. Do you need to recalculate the exercise price each time you issue an ESOP to a new staff member? So I'm assuming each time you issue options to a new staff member. Look, yes, you do. And in the first, if you're within those first 7 years, it's very easy to do that net assets test. It's a simple calculation, and the guidance is also in that ESS guide, which we have the link there. But yeah, each time you do that, and that's why they're typically done in batches as well. So what you would normally do is, let's call it every 6 months or 12 months or 3 months, you would, review your employees and decide to issue options to new employees or to existing employees, because typically these also need to be approved by the board. Most companies will have in the shareholders agreement that any options that are issued need to be approved by the board. And so basically, each time you have your board meeting, most of them are quarterly for startups. That's a great time to be getting the approval for these and doing that net assets test, so you can firm up that exercise price at that time.
Okay, and so the next question that I'll answer relates to voting rights of people who receive equity under the ESOP. So one of the benefits of an ESOP is, because you're granting people options to begin with, they'll start off just being option holders, which means that they won't have the rights of shareholders. So you don't need to deal with additional people that have the right to vote and things like that. So that's really useful in the beginning. But at the time at which they're able to exercise their options and receive shares, they will end up holding ordinary shares, which means that they will have the right to vote the same as other holders of ordinary shares. Something that we do see sometimes is some companies will like the ability in their ESOP documents for the employees to, say, assign their voting rights to the founders. So there are arrangements like that if that is something that you're really concerned about. But yeah, the default principle is that if they end up with ordinary shares, then they will have the same rights, including the right to vote. And just on that point as well, there was a question that came in that wanted us to elaborate a little bit on holding shares in a trust to streamline shareholding. So yes, certainly happy to elaborate on that. And this is something that, especially for more mature startups that might have raised multiple rounds of capital, and so their shareholding is quite large already, this is definitely something that we end up doing for them. And so what that arrangement looks like is, typically the company will establish a subsidiary company, and that subsidiary company will be a corporate trustee that holds the shares for the underlying employees on bare trust. And that means that even though the trustee is the legal holder, which means that from the company's perspective, you only have a single shareholder that is holding those ESOP shares, rather than individually all of your employees. So you just have one legal holder, but because they're held on bare trust for the benefit of the employees, it means that the employees still essentially have full entitlement to those shares. The trustee has to act on their instructions. So if they want to sell those shares, the trustee has to do as they instruct, and they also are entitled to the full financial benefit of those shares as well. So from the employee's perspective, the financial return that they receive and the financial benefit that they receive at the end of the day is exactly the same. It's just that from the company's perspective, you have a single legal holder, which is that corporate trustee, rather than a whole suite of small employee shareholders.
Great. I think there's been a couple more come through again, so I'll just reiterate on that one. So how do you determine the pre-money valuation for a startup? That's what, as we sort of explained before, it's very subjective, and it needs to be a value that you agree with, you as the founder of the business, and also those investors that are coming in. There's no right or wrong way of doing it. So yeah, it's essentially a value that you guys agree with. It can be done on revenue multiples, EBIT multiples, but yeah, there's no easy way of coming up with it. And a lot of the times you're just investing in, the potential of your business. So you can't actually put, a dollar value to that through, a financial model, essentially. Great.
Okay, so we've got a question here that says, how do you retain control of the company as your ownership continues to get diluted by subsequent capital raises, which is a really good point and is certainly something that's really important for founders. And again, this is one of those things that you're likely going to be revisiting over the life of the business. And one of the principles to be really clear on in the beginning is there is a difference between decision making at a director level and decision making at a shareholder level. And that's one of the critical ways in which as a founder, you're able to maintain control and decision making is making sure that as many decisions as possible is done at a director level rather than a shareholder level, both in terms of the fact that, it's just easier often if you have heaps and heaps of shareholders, but, only say 5 board members, of course, it's going to be easier to decide those things at a director level than at a shareholder level. So that's one of the things to be clear about is as you grow and as you end up with different types of shareholders, making sure that your shareholders agreement is really clear on what is decided by directors and what actually needs shareholder approval. And in most cases, those things can be fairly minimal, or at least can be limited to decisions that have to be approved by, say a certain set of larger investors. So you're minimizing the administration of having to go back to shareholders all the time. And to that point as well, that's also something that, say, at a board level, you revisit and you change over time. So, for example, if your shareholding ends up getting diluted, or as your the number of board members grow, there is the capacity, at subsequent capital raises to negotiate things like potentially having, 2 votes per founder, or having the ability for founders to appoint additional representative directors to make sure that you maintain that control. So yeah, it's something that there's no kind of clear-cut answer to begin with, because it's something that you will be changing over the life of your business to make sure that it's suitable for a particular period in time.
Great, thanks for that, Sophie. I think, guys, we're coming towards the end of the webinar, so there's probably another 50 questions that we have there, so apologies we can't get to them all, but yeah, we'll try and, we've got an offer coming up as well, so what we can do is, as part of this offer, you can ask, some of those questions directly. So guys, anyone that was part of this webinar is eligible to receive a complimentary strategy session and redeem a special offer when they sign up to LegalVision's membership. What is our membership? We call it at the moment LV Connect Pro. It's a membership for all SMEs, in Australia and New Zealand. What we offer is all BAU legal work included in this membership. So that, that is contract reviews, employment advice. It also gives you access to our call service. We have lawyers, always available to contact and answer any questions that you have. And basically, all it is, it's a membership for a simple monthly fee under a 1, 3, or 5-year contract. And we find it's really good at providing, ongoing value for our clients. And we've, had a great uptake the last couple of years on that. So basically, yeah, so let's use the complimentary strategy session to discuss any of your capital raising and ESOP needs, business more broadly, and how we can help you support via that membership. So to book a strategy session and redeem that offer, you can click yes in the survey that will appear after the webinar and leave your contact information, or email reply@legalvision.com.au and mention that you watched this webinar. So guys, I just wanted to say thank you for joining, and I hope it's been valuable. And yeah, Sophie, I'll leave you for the final thoughts.
Yeah, thanks everybody. Hope that was useful, and looking forward to potentially speaking to some of you as part of the strategy sessions, or working with you guys if you do end up raising capital or implementing an ESOP. So yeah, thanks everybody.
Thanks, bye.
Bye.